in a placid market with maybe placid car price hikes on cars the start of the new year, is the year promising to be anything but placid? I think that's the question that we take to Mr. Nilesh Shah, MD of Kotak Mahindra AMC. He joins us right now on the show. And remember, we had a very nice conversation with him when Kotak AMC came out with their year-end outlook too. But as we are coming to the end of the year, and as I see Nilesh bhai clad in this funky new avatar of his, Nilesh bhai, thanks so much for joining in. I wonder if this is a precursor to the year looking a lot more colorful than what 2025 has looked like for equity investors.
Well, if my colors can make the market colorful, I'll be changing it every day. And I'll stop wearing red and only wear green. But market is not driven by anyone's color or who is buying and who is selling. It is driven by fundamentals of growth and governance. And I think at least for calendar year 2026 and FY27, we are better poised from a valuation as well as growth point of view.
Okay. So, Nilesh bhai, I mean, that's the key thing. I mean, we were talking to some global strategists as well, and they were saying that for India, perennially the problem was the valuations and the growth, and the valuations were high. Growth in 2025 wasn't the best. Now we've seen 2025 correct a lot of that, right? Relative valuations, absolute valuations, and growth for FY27 seems to be looking very strong relative to 2025 and FY26. So is that a sufficient set of conditions for the markets to behave well? Or does it need the added layer of maybe a trade deal, maybe some better macros, maybe the AI deal across the world coming off a little bit? Is all of that also important?
So undoubtedly, you need little bit of luck also. And apart from what you mentioned, Neeraj bhai, there are two things where India needs to be lucky. One, wherever dollar has depreciated, investors have taken money out of American market. Dollar is down about 10% plus this year. And investors have invested about $30 trillion in US Treasury, equity market, and other asset class. A 10% depreciation means loss of $3 trillion. But for a variety of reasons, we haven't yet seen investors pulling money out of American market. Now, in CY26, can we see investors taking money out of American market? If that happens, there are more chances of money flowing to emerging market, including India. The second luck which we need is Chinese market. Chinese markets have rallied in last 2 years. They are up 40% plus, but they are still trading where they were in 17 years before. In this 17 years, Chinese markets have gone up 5 times and come down 5 times. Will investors be lucky 6th time, or history will repeat? From our point of view, we would love history to repeat. If Chinese market falls and investors withdrew from America, quite likely that some amount of flows will come towards India. So we need little bit of luck apart from our own fundamentals to ensure that CY26, FY27 becomes more rewarding to investors.
Nilesh bhai, very good morning. Tamanna here, and I'll join Neeraj in compliments for your look. I'm sure it's going to be a very exciting 2026 as well. What are you making of this metals madness? Is any of it making sense? Sometimes you almost feel like it's, portending something really big that's going to come. With silver moving some 6-7% within a few hours, what's happening with platinum, with gold, with copper? What are you making of it?
So one, we have to, Tamanna, differentiate between industrial commodity and precious metal. Gold is driven by central bank buying, and the objective is essentially diversification of their FX reserves. Post Russia's freezing of $500 billion reserves post-Ukraine invasion, every central banker is looking to diversify their asset base. The Western central bankers have, led by US, Germany, France, they have put 60-70% plus their reserves in gold. The Eastern central banks led by China, Japan, India, they haven't put even 15% of their reserves in gold. undoubtedly there is a diversification play going on. As long as central banks continue to buy gold and the price up to which they will continue to buy gold, gold prices will get supported. On the silver side, there has been industrial demand as well as rumors of central bank buying. Russian central bank, Saudi central bank seems to have bought silver through their front organizations. Plus, there is industrial demand from electric vehicle and solar cells. There is also some amount of speculation when things have moved so fast. The general doubt is short covering. So gold and silver focus on central bank activity. In silver, undoubtedly, there is some amount of short covering, so there could be correction. On the other side, copper and other industrial metal, we believe they will be cyclical. Today, they are benefiting from uh, dollar depreciation, dollar weakness. But at a price, people will replace industrial demand because otherwise cost will become prohibitive. So on industrial demand, play for cyclicality, gold and silver focus on central bank activity.
You know, the other aspect is what equity plays linked to some of these commodities are doing and the impact they're going to have, Nilesh Bhai. One is, of course, pure play, your precious metals and your industrial commodities and how they are moving, maybe as an investment option. But the impact they're going to have, as on one end, they increase the cost of raw materials. On the other end, miners, refiners become more valuable. Do you see that as a short-term trend or something which will re-rate?
On the miner side, in Indian market, we hardly have any company. Globally, there are some opportunities available through funds. But do remember that many a times miners go and hedge themselves in the future. So you want to play unhedged miners and refiners rather than hedged miners and refiners. In terms of industrial metal, uh, many a times we make the mistake of assuming that the trend will continue. Do remember that industrial commodities do get replaced at a higher price, at a higher cost, and hence there will be cyclicality. Normally, the thumb rule is to buy low and sell high, buy on a cheaper valuation and sell on expensive valuation. In the commodities, many a times you have to buy when valuation looks on the higher side because commodity prices are down, prices are low, and companies are making losses, which makes valuation look higher. And you have to sell when valuations are looking cheap, commodity prices are high, companies are making huge profit, valuation looks low, but the commodity cycle could be reversing. So in commodity sector, you have to ensure that you provide enough for cyclicality.
Got it. Okay. So Nilesh bhai, that is accounting for one of the hottest pockets right now. But one would reckon that if 2025 had a defining characteristic from the government side, it had to be the pivot towards consumption, isn't it? I mean, the tax cuts that came in earlier, then the GST cuts. And we've seen some flavor of that starting September 22nd. My larger question though, do you reckon that it continues into 2026 as a year because GST is a long-standing gain and therefore does discretionary consumption stand to gain a lot in the equity markets in 2026?
Undoubtedly, Neeraj bhai, apart from income tax cut and GST tax cut, there is also reduction in interest rate, which benefits EMI borrowers. The savings to the borrowers is about 1,80,000 crore plus. There's also banning on gaming. That's putting money in the pockets of speculators of about 1,20,000 crore a year. And come 2027, we will see eighth pay commission getting effective. There are about 1.2 crore defense, PSU, central government employees and pensioners who will benefit from eighth pay commission. That fiscal impulse could be between 0.6 to 0.8% of GDP. So there will be money in the pockets of taxpayers, in the pockets of borrowers, in the pockets of consumers, in the pockets of speculators, and in the pockets of government employees. Wherever this money will be spent, those sectors, those companies will have volume expansion and hopefully margin expansion. So consumer discretionary is likely to be a multi-year theme based on this money in the pockets of consumers.
Okay. Nilesh bhai, the other thing is this whole theory that some people have around the revival of the CV cycle. One, what it does to that whole CV ecosystem, a small ecosystem, but nevertheless it is there in the listed space. But two, also it's a precursor towards what the economy will do, etc., etc. Are you sensing that? You have tons of experience of these cycles, right? Do you believe a CV cycle is underway, and is that a precursor to stronger economic growth in the next 2 years?
So नीरज भाई, many a times खट्टे अंगूर की कहानी भी हमारे लिए सही होती है. Our experience has also taught us many a times to
Not to
miss
believe.
an opportunity because of khatte angur. So commercial vehicle is one of that space. It's a space where undoubtedly efficiency and productivity in terms of removal of octroys, improvement in national highways, toll collection via RFID, faster turnaround, the dedicated freight corridor. Every time there has been improvement on logistics side, there is an adverse impact on the commercial vehicle side. So we do believe now, from a cyclicality point of view, commercial vehicles seems to be doing well, both in medium as well as heavy commercial side. But will that trend last long? Or let's say full-fledged implementation of dedicated freight corridor can shift some of those revival. So on commercial vehicle side, I will be a little bit more careful. I think there is better opportunity in two-wheeler, in passenger vehicle, in auto component compared to commercial vehicle. But undoubtedly, commercial vehicle cycle is on the up move.
You know, I'm wondering for the outlook 2026, and let's shift a little bit of focus there, Nilesh bhai. In terms of primary market buzz, do you continue to see opportunities for investors and, of course, for fund managers as well to discover new options and newer kind of companies coming in? Because from what early signs are telling us, the 2026 IPO pipeline is going to be as exciting, if not more than 2025. How are you looking at that trend?
Undoubtedly, Tamanna, the pipeline is good. SEBI has ensured that quality businesses come out for IPO, and then investors have to pick up on valuation. 2025, we have seen some high-profile IPOs not delivering return to investors. So from a fund manager point of view, there's no differentiation between an existing investment, a listed company vis-a-vis IPO. We have to do the same work from a research point of view. And clearly, we have to bet where we are confident. One strategy which probably will change in the coming year is that more and more investors will be looking to get meaningful stake in the anchor allotment stage. Pre-IPO will now move from mutual funds to other investors, and hence more and more mutual funds will focus upon getting meaningful stake in the anchor allotment.
For mutual fund investors now, I would say 2025 has been a bit of a mixed bag. And I won't make the mistake of asking you what you think the returns will be in 2026, but will there be an improvement from where we are right now? Do you see 2026 where some of these issues that have been an overhang, trade deal, etc., among them, now start to dissipate?
So undoubtedly, we believe CY26, FY27 experience of investors will be better in small cap, in mid cap, and probably in large cap. It may not be as good in precious metal space. The kind of parabolic move we have seen, we may not see that in precious metal, even though outlook remains positive. So overall, the experience will turn positive compared to CY25, where there was a very wide range of return differential between, let's say, precious metal to small cap. That range will narrow down, and hopefully all of them will be in positive territory. And dare I say, in real return, better than inflation.
Nilesh bhai, I have a big elephant in the room question, and it's almost difficult to answer, but I'm still interested in asking you. And what Coforge has done over the weekend, or what some of the other IT companies have done, that after a while that organic growth seemed to plateau, they started doing the inorganic strategy. And not a bad idea considering they throw up oodles of cash and they can invest it somewhere. Do you reckon that Indian IT could follow a playbook of acquiring AI capabilities through inorganic moves and therefore having them within their ecosystem, not disturb their growth rates too much, and the markets may reward them? Because 2025 was filled with doubts of whether Indian IT will be able to deliver on the IT holy grail. Maybe they will, but via the inorganic move, which may not be too bad.
So, Neeraj bhai, the jury is still out over there whether acquisition adds value to the company or not. We have seen successes, we have seen failures. So, is there a one standard size that will fit all the questions? Answer is no. The companies will have to ensure that they are paying appropriate value for the acquisition. Second, they'll have to focus on integrating acquiring companies into their own company, including management retention, culture retention, and supporting fair business practices. Uh, if the companies have paid right value and focus on integration, then certainly it will create value. But Neeraj, I will just give one experience of mine, which could be eye opener to investors. We had invested in an IT company in the 2000 era. They had gone and acquired a much larger company, and the stock market reacted positively towards that. Over next couple of quarters, the stock kept on falling, and we couldn't realize why. Much later, I recognized that the company had, when they made such a large acquisition, they had accounted for goodwill, because in software, there's hardly any real assets. A lot of it is goodwill and knowledge value. And they didn't depreciate the goodwill, so their profitability was looking better and better. So when you do an acquisition, as an investor now, I'll be very, very careful on accounting for the goodwill. Is goodwill getting depreciated appropriately? If yes, then the right value and right integration will create value for investors.
Right, for companies and for investors, right? Finer points which have impacted companies and valuations in the past, and comes from experience, Tamanna.
Yeah, I wonder if valuations will be relatively on our side in 2026 and FY27, calendar year 2026 and FY27, Nilesh bhai, considering that has been where the knockdown took place, isn't it? Especially in small and mid cap.
So, Tamanna, if you're looking at 20-25% return, then valuations are certainly not in your favor. If you are happy with high single digit, low double digit return, then these valuations are reasonable. So one will have to moderate return expectations to invest at current valuation. If you are looking very high return, then this is not the valuation. Then you have to pray for more correction, which may or may not come.
Pray for more correction, which may or may not come. Well, we hope the may not happens rather than the may come. I think crystal ball gazing has become a hazardous job right now, from what we've seen in the last year. Wouldn't you agree, Nilesh bhai? If rewind to last year this time, and we may not have seen the events that took place, starting from how that trade deal went south. First of all, the tariffs, then we had a war in the neighborhood, and then an improvement in corporate results.
So experience has taught us that there is always a surprise and a shock. You'll never be able to predict future. So better than trying to predict future, focus upon how you react to the events which happen. Ignore the noise, focus on fundamentals.
Ignore the noise, focus on fundamentals. Well, those are evergreen lessons which work 365 days of the year. Thank you so much for that. Nilesh Shah there. Wish you a very, very happy new year from all of us here at NDTV Profit.
Thank you.